Okay, welcome to another edition of Ask Spurrell CPA. Today we're talking about organizing your income statement, and I'm here with Tyson from our firm. Tyson, thanks for being here today on the show. And Tyson, tell us a little bit about your journey to the firm here and how long you've been here.
Yeah, I've been here for 2 years now. I took my 4-year Bachelor of Business Administration and emphasis in accounting at NAIT, and I'm currently pursuing my CPA designation now.
Right on. Okay, so why organizing your income statement is important is 80% of small business owners would score less than 70% on basic business financial literacy tests, which is a little bit scary because there's a lot riding on these small businesses and knowing that they're going to get significant components wrong. So what we're focusing on today is that part of the financial statement is the income statement. And the story that we have is we get entrepreneurs who come in and they have these long income statements, and you can't fit them on one page, or they're 3 and 4 pages long, and the organization is off, and now they've come to us because they've probably made bad choices. They've run out of cash. They've bought a piece of equipment that's not working out for them. They hired staff and they can't afford to pay them. And a lot of it has to do with the organization of that income statement and having something that's usable and user friendly. So these entrepreneurs who are coming in, we're seeing they come in with the disorganized or too long financial statements. What are the questions you think that they should be asking, Tyson?
The first one would be, what are the main four sections of an income statement?
So the sections of the income statement, you start at the top, being revenue. So that's, simply the gross amounts that you're bringing into the business, the gross invoices that you're billing out to your customers. Then followed by the cost of sales. So the cost of sales are the costs that are directly related to providing those services. So the staff who are working directly on the projects, the supplies or materials that are bought and then sold to the client. So the things that vary directly with every sale, there's another direct input of cost. Following those direct costs, now we're getting into the general expenses of the business. So these are expenses that the business is responsible for, but they don't necessarily vary directly with each sale as the direct costs do. So, the main ones in most businesses on the general expenses are, the rent, the administrative staff, the amortization of the equipment and the buildings that they have in the business, as well as, the office supplies and the utilities, which generally aren't, variable with doesn't vary with every new contract that they take on or every new project that they take on. So, and then, the last thing is the other income or other expenses. And these are the items that don't necessarily do with the day-to-day operations of the business, things like the corporate income tax, the salaries paid to the business owners. So those are the, starting from the top, we have revenue, we have cost of sales, we have general expenses, and then we have other income and expenses. And those are the 4 main sections that people should be organizing their income statement in.
Okay, why is it a good idea to organize your income statement in numerically descending order?
Yeah, great question. So, some people organize it alphabetically, and some people, I don't know, they have some sort of artistic interpretation of why they've organized it, I'm not sure. But numerically descending is going to keep you focused. So what the exercise I like to do with a lot of business owners is you have this income statement, and you literally draw a line in the middle. Once you have this organized in numerically descending order, and now you're going to have all the big numbers at the top. You're going to have your revenue. You're going to have your cost of sales. You're going to have generally the rent that you're paying, the administrative staff that you're paying, and maybe you have a supplies account. But at the bottom, you're going to have things like income, interest and bank charges, maybe the cell phone bill. And business owners tend to be very fixated on those little items, and they can spend a lot of time on those little items that aren't really going to move the needle for it that much. We all only have 168 hours in the week. The time that we need to spend needs to be focused on those other items. What's the gross margin on every project if you're a construction guy? What is the gross margin on every patient you see if you're a medical practitioner? And, failing that, what are the costs of those administrative staff that you have? What are you paying for rent? These are the items that are really going to make a difference in your business in terms of what the net profit that's left over. We don't want to get sucked in, into the weeds and, be spending 8 hours, trying to make our interest and bank charges from $35 a month to $30 a month because that's how we lose money. So,
should your income statement be more than 1 page long?
no, small businesses, your income statement needs to be on a page. You need to be able to use this thing to make business decisions quickly. And you need to refer to it. If every time you have to make a business decision, you have to look through multiple pages, we should have the ability to drill through, but we need to be able to summarize in 1 page so we can make decisions, intuitively on good numbers. And if you can summarize your income statement onto 1 page, that's the game plan for small businesses. If it's longer than that, it's usually overly complex, and it's going to result on making decisions on bad information rather than sometimes people think they'll make better decisions on more detail, and they tend to just lose track of the big picture.
What happens to classification and variance analysis when your chart of accounts gets too big? Yeah,
so let's take office supplies, for example. We would just rank it with office supplies, and most small businesses, and a lot of small businesses are gonna spend, no more than $5,000, maybe no more than $10,000, maybe even no more than $20,000. But it's not going to be that huge number. It's not going to be what you're spending on salaries. It's not going to be what you're spending on rent. But let's say that business owner thinks that I think I'm gonna make this more sophisticated, and I'm going to have one for ink toner, and I'm going to have another one for paper and pens, and I'm going to have another one for general office supplies. And they think that they're doing themselves a service, and what tends to happen is the more complex that you get in those classifications, the more errors that you make. So your classification starts to become ambiguous. Do I put it in general office supplies? Do I put it in, if I bought a stapler, is it in paper and pens, or is it in this one? And they tend to start actually being rather ambiguous in their classifications. And when you start to look back on the historical performance month to month or year to year and see how you're doing year over year, you actually lose track of it, and you've just classified it a different way rather than you've actually changed your spending habits in any meaningful matter, really.
Right. Is it okay to use sub-accounts or items if you need more detail?
Yeah, that's the move. You don't want to have so many primary accounts that this thing is going to be 2, 3, 4 pages long. If you absolutely do need more detail, you can use sub-accounts. Or even better, most bookkeeping software, they have items in there. So if you actually ever do want to track it, by supplier, or if you have a specific item, you can run a report later on that item if you want to get deeper into the analysis, but it doesn't cloud the big picture income statement that you can use to make real high-level decisions quickly and efficiently and regularly.
Why do you recommend no more than 3 revenue accounts?
So you want to be able to wind up your revenue accounts into no more than 3 revenue accounts because that's where the planning happens. Let's say you have a restaurant, or and you have 50 different things on your menu, or you're a doctor and you have hundreds of things that you can bill for. Or you're a construction guy and sometimes you come out and fix a door, and sometimes you build someone a new house. There's a huge variance, but ultimately you can boil these things down into no more than 1. If you're the restaurant, you have, what is the average, what's the average bill size every time someone walks through the door? Every person that walks through the door orders an average of this off the menu. If you're the doctor, every patient who comes through the door, you bill them this. If you're a construction guy, your average project is this. That lets you plan. If you try to plan how many, orders of onion rings you're going to sell in a small business, we're not McDonald's. We don't have enough data in order to run that. So you're actually going to be off in your projections. If you can boil it down to an average, in a small business, you're going to have enough data to actually make reliable projections. So it's all about getting to an average item size, an average ticket size, an average widget, if you will, and then you can do reliable projections on that average.
Okay. What sort of things should you be putting in your direct cost of sales section?
Yeah, so, to touch on that again, the direct cost of sales, these are the things that vary, with every sale, if you will. So, we'll go back to the construction guy. So in the construction guy, every time he does a new project, he has to buy more materials. He has to pay subcontractors, and maybe has self-perform work from the guys who are doing the projects on the work. So these aren't the people in the office, these are the people out in the sites doing it. You go to the medical practitioner, and these are the associate doctors. For every, in a dental clinic, for every $100 that's billed, they got to pay out $60 to the associate dentist. So that's a direct cost. Every time there's a sale, there's an associated cost with it, right? So it's the things that very directly, there's a cost incurred that directly correlates to every sale.
In most businesses, what are the most significant general expenses?
Yeah, the significant general expenses, the key culprits, if you will, it's generally going to be the cost of your administrative staff. That's going to be pretty significant. You have 1 or 2 salaries, 3, 4 salaries, even in most small businesses. That's a big line item. So the cost of those administrative salaries is up there. Rent is usually up there. Usually people are paying a significant portion of revenue on rent, and usually amortization of the property, plant, and equipment. Those are probably the 3 most common that are likely to be at the top of your income statement that deserve your time and attention, where if you can make an improvement in one of those, you're really going to make significant differences in your profitability, as opposed to spending time on how much you spend on can you get a bundle of paper for $20 or $18. It's not going to make a material difference in the income at the end.
Why should you not put salaries to the owners of their families in direct cost of sales or general expenses?
Yeah, so if you think about the organization of the income statement, you're going to have the revenue, you're going to have the direct cost of sales, and you're going to have the general expenses. Right under the general expenses, you're going to have a line that's called income from operations. If you haven't put the owner's salary in the general expenses or the direct cost of sales, that income from operations is going to be the best number to tell you what do you make in your business before the owners and their family gets paid. And that's the number one tax planning number that we need. That's what's available. Often the owner's salary is more driven by lifestyle choices or tax strategy rather than how much it would actually cost them. So it really gives you that nice number of how is my business doing before I pay myself? What do I have available to pay myself? So that's the value of doing that.
What sort of items go into the other income and expense category?
So the sort of items that go in the other expense category are, now you do have to account for those salaries to owners. And it's really nice whenever you're applying for financing. That's the first thing. If you don't organize your statement this way, you're immediately talking to the banker and they want to say, well, how much are the owners getting paid in that salary line item? So you're going to put the salaries to the owners and their dependents, the other family members who are being paid out of the business. That's going to be a standalone item in there, and it's really nicely organized for financing or planning purposes. Also, the corporate tax is also going to be in that other income and expense section, as well as generally there's going to be some investment income. If the business itself is saving, which is normally a prudent tax strategy, you're going to have the investment income. So if you're I go back to the doctor, a restaurant owner, or a construction guy, if you buy shares in Apple in your corporation, that doesn't really relate to your business, but we need to account for it, but we don't want it clouding that income from operations number. So it's the income and expenses that aren't directly related to the day-to-day business.
Is net income as important as income from operations?
Although net income is important, it's probably not as important as income from operations. And the reason is because often net income is tax driven. The business owner might have made $100,000, but let's say they took out $150,000 because they bought a new house this year and we declared extra salary. That doesn't mean their business did any worse this year. Lots of times it just means they took more money out of the business, which often revolves around life events rather than how well the business is doing. The business might have been doing better than last year, but if you look at that net income item, you're not taking into consideration those items that don't vary with the business. How much were the owners paid? Did my investments do well or not? That doesn't have any effect on the main business. It has to be accounted for, but you want to be able to isolate the difference from those two. So I think that's all we have for today. Thanks again for watching. If you have any comments that you'd like to have answered, please put them below and we'll try to address them in a future video. Thanks very much.